Welcome. If you've got $1,000 to invest in 2026, you're already ahead of the game. Today, we'll walk through a practical step-by-step approach to making the most of your money. Whether you're new to investing or looking to refine your strategy, this guide will help you make informed choices. Let's start by understanding your goals and risk tolerance, which are the foundation of any successful investment plan. By the end, you'll have a clear roadmap for putting your $1,000 to work. For investing, it's crucial to clarify your financial goals. Are you saving for a short-term purchase, building an emergency fund, or planning for long-term growth? Your objectives will shape your investment choices. For example, if you need the money within a year, you'll want safer, more liquid options. If you're investing for the long haul, you can afford to take on more risk for potentially higher returns. Take a moment to write down your goals and keep them in mind as we move forward. Understanding your risk tolerance is key to choosing the right investments. Some people are comfortable with market ups and downs, while others prefer stability. Think about how you'd feel if your investment dropped in value temporarily. Would you panic or stay the course? Your comfort level with risk will guide your asset allocation. Remember, higher returns often come with higher risk, so it's important to find a balance that suits you. Before diving into investments, make sure you have an emergency fund. This is a safety net for unexpected expenses like medical bills or car repairs. Experts recommend saving at least 3 to 6 months worth of living expenses. If you don't have this cushion yet, consider putting part of your $1,000 into a high-yield savings account. This step ensures you won't have to sell investments at a loss if an emergency arises. If you have high-interest debt such as credit card balances, it's wise to pay it down before investing. The interest on these debts can quickly outpace any returns you might earn from investments. By eliminating high-interest debt, you free up more money for future investments and reduce financial stress. Consider using a portion of your $1,000 to pay off outstanding balances, then focus on building your investment portfolio. Next, you'll need to choose the right account for your investments. Common options include brokerage accounts, retirement accounts like IRAs, or even robo-advisors. Each has its own benefits, fees, and tax implications. For beginners, a simple brokerage account is often the easiest way to start. If you're investing for retirement, consider an IRA for potential tax advantages. Take time to compare options and select the one that fits your goal. There are many ways to invest your $1,000. Popular choices include stocks, bonds, mutual funds, ETFs, and even alternative assets like real estate or cryptocurrencies. Each option comes with its own risk and potential return. Stocks offer growth but can be volatile. Bonds are more stable but offer lower returns. Mutual funds and ETFs provide diversification, spreading your money across many assets. Consider your goals and risk tolerance when choosing where to invest. Many investors, index funds are a smart starting point. These funds track a market index like the S&P 500 and offer broad diversification at a low cost. By investing in an index fund, you're essentially buying a small piece of hundreds of companies, reducing your risk compared to picking individual stocks. Index funds are known for their steady long-term growth and are a favorite among both beginners and experts. If you're interested in big-name stocks but don't have enough to buy a full share, fractional shares are a great solution. Many brokerages now allow you to buy a portion of a share, making it easier to diversify your portfolio with limited funds. This means you can own pieces of companies like Apple or Amazon even with a small investment. Fractional shares help you get started without needing thousands of dollars. Automation can make investing easier and more consistent. Many platforms let you set up automatic deposits and recurring investments so you don't have to remember to invest each month. This approach, known as dollar-cost averaging, helps smooth out market ups and downs by spreading your purchases over time. Automation also encourages disciplined investing, which is key to long-term success. Diversification is a fundamental principle of investing. By spreading your money across different asset classes, like stocks, bonds, and real estate, you reduce the risk of losing everything if one investment performs poorly. Even with $1,000, you can diversify using mutual funds or ETFs. The goal is to create a balanced portfolio that can weather market ups and downs, giving you more stable returns over time. Investment fees can eat into your returns over time. Look for low-cost investment options such as index funds and ETFs, which typically have lower fees than actively managed funds. Also, compare brokerage fees and account charges before opening an account. Even small differences in fees can add up over the years, so keeping costs low is essential for maximizing your investment growth. Taxes can impact your investment returns, so it's important to understand how they work. Some accounts like IRAs offer tax advantages, while others may require you to pay taxes on dividends or capital gains. Keep good records of your investments and consult a tax professional if you're unsure about your obligations. Planning for taxes can help you keep more of your hard-earned money. Robo-advisors are automated investment platforms that build and manage a portfolio for you based on your goals and risk tolerance. They're a great option for beginners who want a hands-off approach. Robo-advisors typically charge lower fees than traditional advisors and use algorithms to optimize your investments. If you're not sure where to start, consider using a robo-advisor to get your money working for you. Beyond stocks and bonds, there are alternative investments like real estate, peer-to-peer lending, and even cryptocurrencies. These options can add diversity to your portfolio but often come with higher risk and complexity. If you're interested, start small and do thorough research before committing your money. Alternative investments can offer unique opportunities, but they're not for everyone. Sometimes the best investment is in your own skills and education. Consider using part of your $1,000 to take a course, attend a workshop, or buy books that can help you advance your career or start a side hustle. Investing in yourself can lead to higher income and better opportunities in the future, making it one of the smartest moves you can make. The investment world is always changing, so it's important to stay informed. Follow financial news, read investment books, and keep learning about new opportunities and risks. The more you know, the better decisions you'll make. Make it a habit to review your investments regularly and adjust your strategy as needed to stay on track with your goals. Investing can be emotional, especially when markets are volatile. It's easy to panic during downturns or get greedy during booms. The key is to stick to your plan and avoid making impulsive decisions based on fear or excitement. Remember, investing is a long-term game. Stay disciplined, trust your strategy, and don't let emotions derail your progress. Over time, your investments may drift from your original allocation due to market changes. It's important to review your portfolio regularly and rebalance if necessary. This means selling some assets and buying others to maintain your desired mix. Rebalancing helps you manage risk and stay aligned with your goals, ensuring your portfolio remains on track. Patience is one of the most important traits for successful investors. Markets will have ups and downs, but staying invested over the long term is key to building wealth. Avoid the temptation to chase quick gains or time the market. Instead, focus on your long-term goals and let your investments grow over time. Remember, slow and steady wins the race. You don't need a fortune to start investing. Even with $1,000, you can build a solid foundation for your financial future. The key is to start now, learn as you go, and gradually increase your investments over time. Small, consistent contributions can add up to significant wealth thanks to the power of compounding. So don't wait, take the first step today. Keeping track of your investments helps you stay motivated and make better decisions. Use apps or spreadsheets to monitor your portfolio's performance, contributions, and growth over time. Tracking your progress also makes it easier to spot trends, identify areas for improvement, and celebrate your successes. Make it a habit to check in regularly and adjust your plan as needed. Be wary of investments that promise fast, guaranteed returns. These are often scams or extremely risky ventures. If something sounds too good to be true, it probably is. Stick to proven investment strategies and avoid chasing the latest fads. Building wealth takes time, discipline, and patience. There are no shortcuts. Compound interest is the process where your investment earnings generate their own earnings over time. The earlier you start investing, the more you benefit from compounding. Even small amounts can grow significantly if left to compound for years. This is why starting with $1,000 today can make a big difference in your financial future. Dollar cost averaging means investing a fixed amount at regular intervals, regardless of market conditions. This strategy reduces the impact of market volatility and helps you avoid trying to time the market. Over time, you'll buy more shares when prices are low and fewer when prices are high, resulting in a lower average cost per share. It's important to set realistic expectations for your investment returns. While some years may bring strong gains, others may see losses. The average long-term return for a diversified stock portfolio is around 7–8% per year. Don't expect to double your money overnight. Focus on steady growth and avoid chasing unrealistic promises. Security is crucial when investing online. Use strong passwords, enable two-factor authentication, and choose reputable platforms. Be cautious with sharing personal information and always verify the legitimacy of investment opportunities. Protecting your investments from fraud and cyber threats is just as important as choosing the right assets. Every investor makes mistakes, especially when starting out. The key is to learn from them and adjust your strategy. Don't be discouraged by setbacks, use them as opportunities to grow and improve. Over time, your experience will help you make better decisions and build confidence in your investing abilities. Investing is a journey, and it's important to celebrate your progress along the way. Whether you've reached a savings milestone, learned a new concept, or simply stuck to your plan, take time to acknowledge your achievements. Celebrating small wins keeps you motivated and reinforces positive habits for long-term success. Wrap Up Investing $1,000 in 2026 is all about setting clear goals, understanding your risk, and making informed choices. Start with the basics. Build an emergency fund, pay off high-interest debt, and choose the right account. Diversify your investments, keep fees low, and stay patient. Remember, the most important step is to get started. Your financial future begins today. Take action and watch your money grow.